These stocks have the potential to at least double. And why should you follow me? Well, you shouldn't follow anyone blindly, but for a bit of context, I've been trading UK stocks for a living for 8 years now, and I've given a TEDx talk and written for the Financial Times. However, you should do your own research because nobody cares more about your hard-earned money than you do. And also, the facts could change on these stocks tomorrow, so you shouldn't rely on me or anyone else for investment information. I also do not accept payment from companies to talk about them because I like to be able to say what I want and keep my independence. So for example, if a stock is an absolute crock, I prefer to say that and no amount of money is going to make me say otherwise. But I do have my own money in these stocks in the form of either equity or warrants, so I am biased. The first stock is Renault, and Renault is a UK-based manufacturer of industrial conveyor chains and other machine components. It's a thoroughly unexciting business, unless of course you're terribly excited by conveyor chains and other machine components. And yet the stock price has more than held its own throughout 2022 and 2023. It's been the classic sell on news stock for 2 years now, ever since it started an earnings upgrade cycle into April 2022. What I mean by that is that Renault has repeatedly put out good news, only for the stock price to gap up and be sold into every time. But at 34 pence, the stock is now at multi-year highs and showing signs that the seller or sellers have eased. After the last update, house broker Cavendish has given an adjusted EPS of 6 pence for 2024 with 19.2 million of adjusted profit forecast. At the current price of 34 pence, that means the stock is trading on a PE of less than 6. But just because a stock is cheap doesn't mean that it can't be cheap for a reason, so let's look further. There's been zero dilution since 2018, which means no new shares have been issued. That's important because if there was dilution, then it'll be harder for the share price to get back to where it was, as there are more shares available in the company to be bought. The business is self-funding small bolt-on acquisitions, and so there doesn't appear to be a need to come to the market for more funding at the moment. That said, there is a big pension deficit that is sucking capital from the business. Net cash flow was 11.7 million in the interim results, but there was a 6 million outflow for pension contributions, but 2.6 million of this was accelerated and originally planned for H2, so this deficit will become smaller over time, and so I don't believe this is much to be worried about. Obviously, if the business was performing badly and deteriorating, then it would be, but that's not the case here at Renault at the moment. Personally, I'm quietly confident that in the coming bull market, Renault could double from this level. Will this be overnight? Definitely not, unless someone comes in and bids for the entire company. But I think Renault has proven itself to be a resilient business that is now in a growth phase. It's not the same company that had a huge hole in its balance sheet from the past. I believe that along with the earnings growth, the market may eventually want to re-rate the stock from 6 times earnings to a higher valuation. Supreme is a vertically integrated, fast-moving consumer goods company. It's got several divisions: batteries, lighting, vaping, sports nutrition, as well as wellness and distribution. It's got deep established relationships with Duracell, Panasonic and Energizer, but it's the vaping side of the business that does attract a lot of attention here. Now, a lot of people say this is because it's a nicotine product, and private investors have similar aversions to alcohol, tobacco and gambling companies. But whilst all of these can undoubtedly be addictive and ruinous, for some reason these people often leave defence companies out of these moral objections. Now, drinking, smoking, gambling and vaping are all choices. Nobody willingly asks for a bomb to be dropped on them, so to me, I just find these aversions odd. My own view is that defence is necessary. The fact that the UK has 4 Vanguard-class nuclear submarines, each armed with 48 Trident II D5 nuclear warheads that can be fired at targets up to 4,000 miles away and fired stealthily underwater, is a huge deterrent, and these submarines could be anywhere in the world, patrolling silently and undetected, ready to strike at any moment. So anyone wanting to nuke me personally in London would surely think twice about that. But in any case, as private investors, we do get to choose what we invest our money in. So if people want to avoid the stock for that reason, then that is absolutely their choice. But the numbers here are hugely attractive. Supreme is a nicely profitable business, and Broker Shore Capital has initial estimates that will be later solidified of circa 17 pence EPS, which gives the company a PE of 7 at the current price of 120 pence. The cash flow for the first half of the year here wasn't great, an outflow of 2.7 million overall, but this was due to a 16.4 million investment in working capital to support Elfbar, as Supreme was selected as a master distributor for the Elfbar and Lost Mary brands. So excluding this investment, operating cash flow was almost 17 million, and the company does have 5 million of net debt, but also an unused 35 million debt facility in order to make more acquisitions. Sound good so far? Probably, but there is a potential stumbling block. Now, we are awaiting the results of the consultation on possible new UK e-cigarette regulations that ended on the 6th of December 2023. Now, Supreme has made moves to preempt this by changing the packaging to make it less appealing to children, but will it be enough? And under a Labour government, vapes would potentially become available only under prescription, following Australia's move in 2021. And whilst nicotine is addictive, it's actually the tobacco that causes cancer, and so removing vapes, which are a less harmful way of getting a nicotine hit and a healthier way for smokers to reduce their cigarette consumption, makes absolutely no sense at all, but it's clearly a big risk. The company's also seen plenty of growth, however this has come from Elfbar, which it doesn't actually own, but at the current earnings multiple of 7, the risk to reward is priced attractively. Obviously, if the consultation does a lot of damage or a Labour government wins, then these shares could become a lot cheaper, and certainly not in a good way at all. Afentra is an oil and gas company named after the phrase African energy transition, and it's the former Sterling Energy that changed its strategy and board in May 2021. Chief Executive Paul McDade is the former Chief Executive of Tullow Oil, and his objective at Afentra is to buy existing assets and increase the value of these by leveraging his knowledge and connections. Now, Afentra has finally completed its Sonangol acquisition in Angola on the 8th of December 2023. This is a deal that gives the company non-operating interests in 2 blocks in offshore Angola. Cavendish forecasts that with a 1st of December completion date, Afentra will generate 49 million in adjusted EBITDA in 2024 against the current market cap of 70 million. Now, adjusted EBITDA is a pie in the sky number, but profit before tax is forecast at 23.8 million, meaning the company will trade as a single digit PE, assuming everything goes to plan. This is also assumed at $70 a barrel of Brent crude, which, given oil's volatility, could either be conservative or optimistic, so that is a clear risk as well. But what the Sonangol acquisition will do is provide free cash flow for the company to buy existing assets, as well as provide lending facilities with which to go after more targets. Now, I've previously done well with this model at Rockrose Energy, where I bought shares below £6 a share and sold the lot for over £20 per share. So am I looking at this with rose-tinted glasses then? It's possible, but a bet on Afentra is essentially a bet on Paul McDade, and he's definitely bet on himself with a £199,550 direct to buy in August 2022, and other directors have made meaningful purchases as well. BSF Enterprises is a biotech company that acquired cell-based tissue engineering company 3D Biotissues in a reverse takeover in May 2022. It raised 1.75 million at 7.37 pence for this, and raised another 2.9 million at 17 pence in an oversubscribed placing in April 2023. So what does this mean? The company aims to replace animal tissue or meat with lab-grown scaffold-free bioequivalents. Now, the scaffold is a structure that holds the meat together, and this is often synthetic or plant-based, which alters the texture of the meat. Now, to test this, the company has developed meat that was cooked and then eaten, and the results were that the cultivated meat was very similar in appearance to conventional meat in the raw state, and when cooked, the cultivated meat was consistent in terms of appearance, aroma, and searing, as well as crisping. So if we assume that operational cash flow costs will remain the same, then based on the £499,084 used in the interim results, we can then extrapolate around 1 million per year for cash burn. And if we take the 2.9 million raised last year, plus the €612,000 grant from the European Institute of Innovation and Technology, then the company will easily have enough capital for well over 12 months, allowing it time to progress its developments and commercial relationships. What I will say though is that the stock is unprofitable, and so it must be regarded as speculative, because if it can't commercialize any of its tech to bring in enough revenue to cover its costs, then it will need another placing. However, there's a lot of upside here, because along with lab-grown meat, the company is also producing lab-grown animal skin for tanners to test, as well as having sent its patented City Mix to several customers to try out. Now, if any of these do take off, then we could be looking at multiples of the stock price here. PCI Pal provides payment solutions for card-not-present transactions. Basically, anywhere that you pay online or through a call center is classed as a card-not-present transaction, because neither you nor the card itself is present at the transaction. And what PCI Pal does is it solves the problem of handling and storing customer data, which means companies can outsource this risk here and avoid any big GDPR breaches and fines. It was expanding fairly quickly by launching in North America, mainland Europe and Australia, but the company is currently subject of a lawsuit from a competitor, Securio, which saw the shares fall from 89 pence to as low as 39 pence recently. In fairness, a small profit warning also contributed to this low, because broker Cavendish trimmed the company's growth to 19.1 million from the previously expected 20 million, but this is still 28% growth in the top line, and PCI Pal expects its first full year of adjusted profit in FY24. The lawsuit is the artificial depressant on the price here though, and management believes this lawsuit was designed to put a spanner in the company's growth. And if we look at a court witness statement from John Swanson Mackenzie, we can see that Securio offered to buy PCI Pal for 90 pence per share against the current price of 60 pence, which was rejected. So if Securio believes PCI Pal infringes on its patent, why would it try to buy it? And why would a settlement offer be fully rejected? But since this time, PCI Pal has won a total victory in the UK court. Not only was PCI Pal successful in showing that Securio's patent was invalid, but even if it was valid, then PCI Pal's Agent Assist solution would not have infringed it. Securio has also been denied the right to appeal by the judge, Mrs. Justice Bacon, although it is allowed to seek permission to appeal from the Court of Appeal. Now, PCI Pal is seeking the maximum recovery of costs in the UK, but it's not out of the woods yet. The US lawsuit is still ongoing, but PCI Pal couldn't really have asked for a better result here in the UK. Now, a catalyst for closing any value disconnect would be the removal of the lawsuit's uncertainty, weighing like a noose on the stock price of PCI Pal. However, should the lawsuit go the wrong way in the US, then the share price could go much lower. Let me know what stocks you're picking for 2024. YouTube says you might like one of these videos, so thanks for watching and hopefully see you in a few seconds.